3. Insurance to protect assets. Life insurance policies provide cash to protect the financial interests of dependents and beneficiaries in the event of the death of the individual whose life is insured. Disability income replacement policies protect the financial interests of a life insured should he become disabled and unable to work and earn any income due to injury or illness. Yet neither life insurance or disability insurance protect an insured's assets, investments, RRSPs, real estate, etc., and future estate value with a tax-free benefit to assist him for the payment of any health-related expenses if he suffers a catastrophic illness or condition and survives, perhaps for years or decades. The insured could possibly even return to work, albeit with altered health circumstances. Critical illness, CI, insurance and long-term care, LTC, insurance provides such living benefits and help protect assets from erosion due to prolonged health-related expenses. Critical illness policies are designed to provide a tax-free sum of money to assist an insured in adapting to his changed circumstances caused by a life-threatening illness. And long-term care policies provide tax-free funds for care services for those insured persons who can no longer care for themselves independently, due to illness, injury, or the effects of aging. 3.1 Critical illness, CI, insurance. Individuals that suffer such catastrophic health events as a life-threatening cancer, heart attack, or stroke may, or may not, eventually be able to return to work full-time, but they will almost certainly incur expenses or changes in their lifestyle that are not covered by conventional disability insurance. These individuals might require funds to permit them to make substantial lifestyle changes to accommodate the changes brought about by their medical condition. There are no particular restrictions on how the benefit can be used. Black small square paying off debt, such as mortgages or credit card balances, to ease the financial stress arising from a prolonged recovery period, increased medical expenses and/or a reduced future earning capacity. Black small square alternative treatments to those covered by provincial medical plans. Black small square home renovations required to accommodate changes in the individual's physical capacity, for example, widened doorways and ramps to accommodate a wheelchair. Black small square choice to work part-time, due to reduced physical capacity or simply a desire to spend less time at work to engage in other activities, a common psychological response to a brush with a life-threatening condition. Black small square conventional medical expenses not covered by provincial health plans. Black small square vacations to help lower medical stress. Black small square changes of employment to a job with lower stress or physical requirements, with an attendant decline in earning capacity, black small square, etc. Without CI insurance benefits, these lifestyle changes could have a significant negative impact on one's assets. With improvements in emergency medical treatment and medical care in general, the pool of individuals who suffer a life-threatening condition and live is expanding. Consider the following Canadian statistics for the 4 most prevalent critical illness conditions alone. 19 Black small square 1 out of every 2 heart attack victims is under the age of 65 and 95% survive their first attack. Black small square 1 out of 3 Canadians will develop some form of cancer and 65% of them will survive for at least 5 years. Black small square 1 out of 20 Canadians will suffer a stroke before age 70 and 75% of those will survive it. Black small square between 3 and 5% of critical illness claims are made by people who had coronary bypass surgery. Most people will know of, or be related to, someone within this group and will appreciate the value of, and need for, CI insurance. 3.1.1 Coverage provided introduced in Canada in the mid-1990s as a standalone contract, CI insurance offers insured individuals a lump sum payout to be used at the discretion of the insured should he suffer any one of a broad range of life-threatening or life-altering conditions. 3.1.1.1 Minimum/maximum issue ages for adults. Policies will usually be issued for qualifying applicants between the ages of 18 and 65, after which the risk of claim becomes too high for most insurers to wish to assume. There are also special, more limited, children's plans available offering much lower benefits than the adult plans. 3.1.1.2 Minimum/maximum face amount. Policy minimum and maximum face amounts vary by insurer, with some issuing contracts for as little as $10,000 and others willing to go as high as $2 million. The more typical face amounts are in the range of $50,000 to $500,000. The actual amount of coverage issued to a given applicant will depend on a number of factors, including Black small square age, Black small square financial status relative to the amount of insurance applied for, to avoid overinsurance. Black small square current health status. Black small square applicant's medical history. Black small square applicant's parents and siblings' medical history. 3.1.1.3 Qualification period. It is standard for a critical illness policy to have an exclusionary clause that specifies that an otherwise covered condition that is first diagnosed or which first manifests itself within 30 days of policy issue will not be covered. This 30-day period is called the qualification period. Some insurers may require an exclusionary period between the issue date of the policy and the onset or diagnosis of a condition listed in the policy, before that condition would be covered for purpose of a claim. For example, in the case of cancer, the exclusionary period may be as much as 90 days. This period may vary in time or application from carrier to carrier. The purpose of the exclusionary period is to protect the insurer against anti-selection, applicants seeking coverage because they fear that they may have a covered condition. 3.1.1.4 Survival, waiting, period. Since critical illness insurance is designed to provide benefits to insureds who survive a covered condition, there is also a waiting period between the date that a covered condition is diagnosed and benefit becomes payable, such that the insurer can have a reasonable expectation the insured will, in fact, survive the condition. The waiting period is often 30 days after the date of diagnosis, but may be longer in relation to certain conditions. 3.1.1.5 Duration of coverage. CI insurance policies are issued both as term and permanent contracts. Term policies run for a specific number of years, typically for 10 or 20 years, or to age 65 or 75. Permanent plans run from date of issue to the life insured's age 100, much like term 100 life insurance. The 10 and 20-year term contracts are often guaranteed renewable, but with an increase in premium on each renewal, to age 75. The additional premium is designed to partly offset adverse selection created by the guaranteed renewable without evidence of good health. These plans are also convertible to permanent coverage, up until age 65. Conversion may be effected without medical evidence, but the insured may not be on claim at the time of conversion. Most policies will expire after the payment of a claim at any age. However, as critical illness insurance is a relatively new product, coverage offered will undoubtedly evolve in the years to come. 3.1.2 Types of policies. One of the main ways by which critical illness policies are distinguished from each other is in the number of conditions that are covered. Black small square many basic policies cover 3 or 4 conditions. 3-condition contracts cover heart attack, stroke and cancer, and 4-condition contracts also cover coronary bypass surgery. Black small square many policies extend that coverage to 10 conditions, outlined below under conditions covered. Black small square comprehensive policies will cover 20 or more conditions, also outlined below. Children's policies, under age 18, typically cover most, or all, of the conditions insured by comprehensive plans, but also a variety of conditions that are more closely associated with minors, like black small square muscular dystrophy, black small square type 1 diabetes, black small square cerebral palsy, black small square cystic fibrosis. Many of these plans are convertible to an adult plan once the child reaches a set age, such as 18 or 25. Some critical illness policies are offered through financial institutions which also issue mortgages. These plans are issued with minimal underwriting and are designed specifically to discharge the outstanding mortgage balance in the event that the individual applying for the mortgage should suffer a critical illness while the mortgage remains outstanding. Benefits are paid directly to the financial institution, subject to underwriting of the insured risk at time of claim. Some standalone mortgage life and disability insurance policies also contain a clause for the payout of a benefit in the event that the insured should suffer a critical illness. Guaranteed issue contracts are issued by some insurers without medical underwriting. All that is required is a brief declaration of good health at time of application. Understandably, such coverage will often be more expensive than a similar coverage that is medically underwritten, and the benefits are limited, typically restricted to less than $100,000. Some life insurance policies also offer an optional critical illness benefit, i.e., a basic rider that can be added to the contract, for a relatively low premium. 3.1.3 Conditions covered. Not all critical illness policies cover the same illnesses or conditions, and there are some illnesses or conditions that are not covered by most policies, such as AIDS. In addition, the precise definition of a covered condition may vary from plan to plan. For example, the type of cancer or the degree to which it has progressed as a qualifying condition will vary from one insurer to another. Or the degree of heart muscle damage may determine whether a heart attack is severe enough to warrant benefits under the definition included in a given contract. 3.1.3.1 Big Four: heart attack, stroke, cancer, and coronary bypass surgery. Most critical illness policies at least provide benefits for a qualifying life-threatening occurrence of the Big Four conditions: black small square heart attack, black small square stroke, black small square cancer, black small square coronary bypass surgery. 3.1.3.2 Expanded coverage. In addition to the Big Four covered conditions, insurers offer more far-reaching policies that may provide benefits to those lives insured who contract some of the following conditions. The list of conditions that may be offered as a rider to the basic plan and their number may vary from one carrier to the next. The following example is an indication of the type of coverage that may be offered. Example: Of course, the more conditions that a policy covers, and the easier it is to meet the definitions of those conditions, the more at risk the insurer is of having to pay a claim, so the higher the policy premiums will be. The exact definition of these conditions may vary from policy to policy, although most conditions must be severe enough to be life-threatening before benefits would be payable. 3.1.4 Riders available. The two most common riders available under critical illness policies are the return, refund, of premium rider and the waiver of premium rider. 3.1.4.1 Return of premium, ROP. As an optional benefit, rider, many insurance companies offer their critical illness policyholders the opportunity to add a return, refund, of premium clause to their contracts that would pay back some, or all, of premiums previously paid by the policyholder should the insured die or the policy expire with no claim ever having been filed. The following types of returns can be offered. On death, premiums would be refunded to the estate of the policyholder, or to a named beneficiary, in whole or in part, should the insured die from a cause not covered as a critical illness under the policy, or should he die due to a critical illness but before the end of the qualification and waiting periods. On surrender, premiums would be refunded to the policyholder, in whole or in part, should the policyholder surrender, cancel, the policy after a prescribed number of years, 10, for example, with no claim having ever been filed. On maturity, premiums would be refunded to the policyholder in whole or in part, should the policy mature, expire, at age 75, for example, with no claim having ever been filed. 3.1.4.2 Waiver of premium. A waiver of premium rider may be added to a critical illness policy provided the insured qualifies medically and pays an additional premium. The rider waives all premiums ordinarily payable under the policy in the event of, and for the duration of, a period of total disability of the insured, or the policyholder, if the insured is not the one paying the premiums. The rider is added at the time of policy issue and is usually only available if the insured is age 55 or younger at the time of application. The waiver is usually subject to a waiting period of between 4 and 6 months from the onset of the qualifying disability, and premiums paid by the policyholder may be refunded once the waiting period has expired. Waiver will continue until the earlier of black small square the recovery of the insured from the disabling condition. Black small square a successful claim for benefits for a critical illness. Black small square the expiry date of the policy. The conditions, disability, that would result in a waiving of premiums under the policy are different from those that would result in a successful claim for critical illness benefits. For example, an insured could suffer a minor stroke that is temporarily debilitating and triggers the waiver provision, but is neither severe nor permanent enough in the damage caused to trigger the critical illness benefit. 3.1.5 Payment of benefits. The payment of benefits under a critical illness contract is subject to a number of restrictions. Black small square the diagnosis or first manifestation of the condition, or disease, must occur more than 30 days after the issue date of the policy, the qualification period. Black small square the life insured must survive the diagnoses of the covered condition for at least 30 days, the waiting period, which may be extended to 90 days in some instances, such as a diagnosis of cancer or in the event of a stroke. However, benefits would still be payable to the estate of the insured or another named beneficiary should the insured survive the waiting period but die prior to approval or payment of the claim. Black small square the life insured must usually make a claim within 30 days of diagnosis of the qualifying condition. Black small square the claimant must provide medical proof of the qualifying condition within 90 days of filing a claim, and the insurance company's medical advisors must concur that the condition in question meets the requirements of the policy. Benefits are normally payable in a lump sum, but the policy may provide that the claim be paid in installments. There is usually only a one-time payout of benefits under a critical illness policy, similar to the situation with a life insurance policy. After a successful claim, the policy is cancelled. Example: Sylvia successfully claimed a $100,000 benefit under her CI insurance policy in 2011 due to diagnosis of a qualifying cancer. When she subsequently had a heart attack in 2013, she was unable to make a second claim under her policy because the contract had been terminated upon payout of the 2011 cancer claim. Some policies, however, offer an optional second event rider, whereby coverage remains in force after a successful claim and a lesser level of benefits may be paid in the event of a future, unrelated claim. For example, if the first claim was related to a heart attack, a subsequent claim related to life-threatening cancer might give rise to the payment of a second, lesser benefit. The payment of benefits is subject to the standard exclusions. No benefits will be paid arising from black small square act of war, declared or otherwise, black small square act of terrorism, black small square attempted suicide, black small square self-inflicted injuries, black small square normal pregnancy, black small square criminal activities. Black small square abuse of non-prescription drugs. Black small square non-occupational AIDS/HIV. 3.1.5.1 Tax treatment of critical illness premiums, benefits, and return of premium benefit. Similar to the circumstances with individual disability income replacement policies, premiums paid for individual critical illness coverage are not deductible for income tax purposes. Neither do premiums paid qualify for the medical expense tax credit. On the other hand, benefits received as the result of a claim or a refund of premium are not taxable income in the hands of the recipient policyholder. 3.2 Long-term care. The phrase long-term care often evokes the image of the aged ailing in a nursing care facility. Although that can be part of the scenario, long-term care is so much more. Those in need of long-term care are individuals of any age who can no longer look after their daily physical needs independently. They could be young people suffering from a debilitating condition like muscular dystrophy or multiple sclerosis, those of any age who have suffered an injury, brain or spinal injuries, for example, that have left them severely physically or mentally restricted, or those suffering from the diseases of age, Alzheimer's or dementia. Long-term care itself can range from home care, provided in the patient's own residence, to assisted living facilities and nursing homes, depending on the needs of the patient. The balance of this chapter will examine the extent of the need for long-term care, the types of care available and insurance coverage available to help pay for the costs of long-term care. 3.2.1 Canadian demographics. Despite the diversity in long-term care patient situations, the need for long-term care remains primarily restricted to those over age 65. And, as the baby boomers age, the percentage of the Canadian population over age 65 is going to balloon over the next 20 to 30 years. Diagram 3.1 illustrates population trends by age and gender between 1961 and 2061. In the last 50 years, the age and sex structure of Canada's population has changed considerably. In 1961, toward the end of the baby boom, Canada's population pyramid had a wide base because of the large number of young people, reflecting the large cohorts born during this period. More than 50 years later, the bulge has moved up the pyramid as baby boomers, aged 46 to 65 in 2011, have grown older. The drop in fertility is apparent in the pyramid with a slightly narrower base. As the baby boom cohorts grow older and Canada's population continues to age, the structure of the population can be expected to increasingly resemble a rectangle, as shown by the pyramid for 2061 based on the medium growth scenario of the most recent population projections. Diagram 3.1. Age pyramid of the population, Canada, 1961, 2011 and 206120. According to the medium growth scenario of the most recent population projections, the proportion of seniors could start to exceed the proportion of children in 2017, with a subsequent widening of the gap. The proportion of the population that is of working age, 15 to 64 years of age, has remained at around 68% since the 1980s due to the presence of the baby boomers in this age group. In the next 50 years, as baby boomers exit this age group, this proportion could drop down to the levels recorded in the late 1950s and throughout the 1960s, that is, to approximately 60% of the population. 21 With so many likely to need long-term care assistance and relatively so few entering the workforce to earn and pay taxes to support them, where will future funding for long-term care come from? Individual long-term care insurance, LTC, coverage could be part of the solution to the problem. 3.2.2 Long-term care options. Long-term care isn't just about a stay in a nursing home. The healthcare community offers a wide range of public and private services, each progressively more comprehensive. The most common private/public services available are Black Small Square Home Care, Black Small Square Respite Care, Black Small Square Assisted Living, Black Small Square Nursing Home, Facility Care. 3.2.2.1 Home care. The first tier of long-term care services involves health care in the home of the afflicted individual. This is usually the first choice for many seniors. If at all possible, they would prefer to receive services that could keep them at home for as long as practical. Even those suffering from cognitive disorders, like Alzheimer's, often take comfort from remaining in a familiar environment. Home care can improve seniors' quality of life, while still allowing them to retain their self-esteem and a feeling of security. Home care is most often provided where there is an informal caregiver, family member, in attendance and the patient's need is relatively minimal and likely to be only temporary. However, it can also be provided by professional health care workers or community service workers. Home care services are typically charged by the hour and may not be required on a daily basis. For example, Black Small Square Nursing Care, Black Small Square Companionship Services. Black Small Square Home Help Services, such as Meals on Wheels and housekeeping/cleaning services. Black Small Square Personal Care Services, with the activities of daily living, addressed in a later section, Black Small Square Overnight Stay. 3.2.2.2 Respite Care. In circumstances where the primary caregiver is a member of the patient's family, spouse, child, grandchild, etc., in a home care situation, the need to provide care 24/7, as in the case of an Alzheimer's sufferer, can become very wearing on the caregiver, both physically and emotionally. So that the caregiver's health, both physical and mental, does not suffer unduly, provision needs to be made to provide relief, respite, for at least a short period, from time to time. Relief might come from a few hours of assistance by friends or other family members, from community services or from a paid, formal care facility like a nursing home. Of course, such relief may come with a monetary cost, an overnight stay, or longer, at a nursing care facility, adult daycare, transportation costs, etc. Example. Rudy, age 62, a retired accountant, looks after his 86-year-old mother, who has Parkinson's disease, on an essentially full-time basis. She lives with Rudy and he has to assist her with many day-to-day activities and keep a watchful eye on her to prevent her from accidentally injuring herself. Although Rudy has nurses and care workers coming to his home to offer his mother regular therapy and assistance, the situation is still very wearing on him. Respite care would provide for Rudy's mother to spend a few days each quarter in a temporary stay at a nursing home facility, to give Rudy a much-needed break from the stresses of the day-to-day care routine. 3.2.2.3 Assisted Living. The next step up from home care is an assisted living facility. These are usually transitional residences which offer support services to individuals who can no longer function in an independent living situation, or in their own homes, but whose debilitation is not severe enough to require 24-hour supervision or medical attention. Assisted living facilities offer on-site, part-time nursing support, and assistance with such functions as shopping, cleaning, cooking, and other daily activities which the individual cannot perform or cannot perform without aid. These facilities may be smaller units with only a handful of residents or large, apartment-like structures housing dozens or hundreds of seniors. They are often referred to as seniors' residences. 3.2.2.4 Nursing home, facility, care. For those individuals who have lost the ability to live independently, nursing homes are the preferred solution for those in need of chronic care. Nursing homes offer 24-hour supervision, 24-hour nursing care, and the on-site services of a medical doctor. Their in-house facilities typically offer assistance with the activities of daily living, fully prepared meals, and group and individual recreation activities for their more active members. Some also offer field trips and special facilities for entertaining the patient's families. 3.2.3 Providers of long-term care. There are a number of sources of long-term care services in the community and a number of providers of long-term care insurance coverage. In a given community, services may be provided by all or any of the following: Black small square provincial government, Black small square not-for-profit organizations, Black small square religious organizations, Black small square for-profit organizations, private service providers, assisted living centers and nursing homes. 3.2.3.1 Publicly funded facilities. Nursing home facilities are licensed and regulated by provincial governments, which also provide various levels of subsidy for nursing home patients unable to afford the full monthly fees. The provincial health care plans will subsidize care in provincially licensed facilities for those low-income individuals who qualify based on a means test. 3.2.3.2 Publicly funded home care. As stated earlier, home care may involve both health and support services provided for in the patient's home. When services offered are publicly funded, they may be received in one of two ways: Black small square through a contracted agency paid for by the government, Black small square through a home care agency selected and paid for by the client with an allowance received from the government. 22. 3.2.4 Cost of long-term care. The cost of long-term care can vary from province to province, dependent upon whether the care provided is basic or extensive and the comprehensiveness of the care itself. The degree to which the provincial government will cover the services needed by the insured would also impact the risk exposure assumed by the insurer. Nevertheless, the cost is always substantial. Accommodation in a nursing care facility can cost between $900 and $5,000 per month or more, depending on the type of room and the level of public funding. Table 3.1 illustrates the monthly cost, not subsidized, for full-time residents in a nursing care facility throughout the Canadian provinces. Table 3.1 Monthly costs, not subsidized, for full-time nursing care facilities by province. 23. The above figures are representative only and often show the average cost for nursing care facilities. Provincial health care plans will cover some, but not all, of these costs, often leaving a substantial gap for the patient to cover. And, as many of the provincial subsidies are means-based, more affluent individuals may be required to cover much of the care costs themselves. These costs and subsidies are subject to periodic revision to reflect the impact of inflation. The costs of private nursing care would deplete the resources of most patients, and possibly their families, within a few years. It is exactly this type of financial burden that long-term care insurance, LTC, is intended to relieve, leaving the afflicted free to seek the level of care that they need rather than just what they can afford. 3.3 Individual long-term care, LTC, insurance. Long-term care coverage is most often acquired as a standalone policy, but can also often be offered as an optional rider on life insurance and critical illness insurance contracts. The long-term care rider is added, if at all, at time of application of the base contract and will be subject to separate medical and financial underwriting. It could be that the prospective life to be insured could qualify for the life or critical illness coverage, but not for the long-term care rider. The rider typically carries its own premium in addition to the premium for the underlying policy. Long-term care contracts are not disability insurance in the classic sense. They do not provide income replacement in the event that the insured is unable to engage in gainful employment due to injury or illness. Rather, long-term care plans are structured to provide a daily maximum benefit to cover the costs of professional health care services for insured individuals who, due to illness, injury, or aging, are no longer able to function independently. Long-term care benefits can be paid directly to the service provider like a nursing home, indemnity model, or, more often in the case of home care, to compensate the patient for expenses already paid for out-of-pocket, reimbursement model. 3.3.1 Purpose/Who needs it? Many insurers do not offer long-term care policies to individuals aged 65 or older because of the high risk of claims in these latter years. Conversely, the risk of claims for young individuals is very low. For these reasons, prospects for long-term care insurance are most often those in the range of ages 45 to 55. Although government funding is available to support long-term care services and facilities, the health care system is stressed and the situation will only get worse as developments in modern medicine and technology continue to extend the lifespan of the average individual, seniors in particular. In 2011, almost 5 million Canadians were aged 65 and older, and 7% of them lived in care facilities, according to census data. That proportion climbs to 30% for those aged 85 or older. 24. Insurance coverage is needed, on either a standalone basis or as a rider to life insurance and other policies, to provide funds and benefits for home care and facilities care services for years or decades to come. 3.3.2 Advantages. The most obvious advantage of having LTC insurance coverage is minimization, or even elimination, of the burden of costs for needed long-term care services. This can take the strain off the insured, and often the insured's family, where the cost of care could otherwise deplete their estates and/or financial well-being. A byproduct of the relief of this financial burden is the fact that the individual is now free to seek the level of care he needs rather than the one he can afford to pay for himself. For most insureds, this ensures a better quality and quantity of services than they would otherwise obtain. Lastly, as the individual will be able to afford the services he requires, it will give him a feeling of dignity and self-control, the knowledge that he will not have to depend on the good graces of the government in a time of need in his old age. 3.3.3 Coverage provided. LTC insurance contracts provide protection for the costs of in-home, assisted living or facility services required by individuals who are recovering from an illness or injury or those who have a condition, for example, Parkinson's disease, that requires chronic care. The policy covers many of those expenses that are not covered by provincial health care plans or, within limits, costs for covered services that exceed the benefits permitted under provincial plans. Many long-term care policies also provide funds for respite benefits, as an alternative to, or in addition to, benefits provided for professional in-home care or care in a long-term care facility. Coverage is subject to an elimination period, usually somewhere between 0 and 90 days, chosen based upon the number of days of care that the insured feels that he can self-fund. As with other types of insurance, the shorter the elimination period, the higher the policy premium will be. Coverage is medically underwritten based on a number of factors, including black small square age of the life to be insured, black small square gender, black small square whether the life to be insured is a smoker or a non-smoker, black small square current health, black small square medical history, black small square cognitive ability, black small square current ability to perform the 6 activities of daily living, see below. The amount of coverage is computed based on a maximum daily rate multiplied by a number of days, care days, of coverage, to an overall maximum specified in the contract, $200,000 for example. While the daily maximum cannot be exceeded, the number of days over which benefits may be payable is flexible. Example: Gregory has an LTC insurance policy with a rider that offers him up to 1 year, 365 days, of home care coverage at a maximum of $200 a day. His overall maximum benefit for home care would be $73,000, $200 times 365 days. If some of his care days required less than $200 of benefits, the term of the benefits payable could be extended beyond 365 days until the entire $73,000 of benefits had been paid out. The payment of benefits is subject to the standard exclusions. No benefits will be paid arising from black small square act of war, declared or otherwise, black small square act of terrorism, black small square attempted suicide, black small square self-inflicted injuries, black small square normal pregnancy, black small square criminal activities, black small square abuse of non-prescription drugs, black small square AIDS/HIV. 3.3.3.1 Activities of Daily Living, ADLs. The most common ways that most insurers use to determine whether an insured qualifies for long-term care assistance is if the insured is unable to independently perform any 2 or more of the activities of daily living, ADLs. Dressing, the ability to dress or undress oneself, take off and put on clothes, without the assistance of a third party. Bathing, the ability to wash oneself in a tub or shower without the assistance of a third party. Toileting, the ability to get to and from the toilet, and on and off it, independently. Transferring, the ability to move from bed to chair, to a wheelchair or to another location without the aid of a supporting device, example, cane or crutches, or the assistance of a third party. Eating, the ability to feed oneself without assistance, not merely the ability to prepare food, but to actually eat food without assistance. Maintaining continence, the ability to control one's bladder. In addition to assessing an insured's ability to perform the ADLs, an umbrella test for qualification for long-term care benefits is to determine whether the insured is cognitively impaired. That is to say, can he understand and or communicate the written or spoken word or nonverbal cues? A person who is severely cognitively impaired would be considered sufficiently disabled to qualify for LTC insurance benefits. Cognitive impairment could arise from a number of causes, including stroke, heart attack, and such conditions as Alzheimer's or Parkinson's disease. Certification of cognitive impairment, or of qualification under the ADLs, would be provided by the patient's attending physician or by a physician associated with a care facility. Such certification could, of course, be subject to verification by a physician chosen by the insurance company. 3.3.4 Long-term care riders available. Although there will, of course, be exceptions in the marketplace, the following are the most common riders available under long-term care contracts. Black Small Square Cost of Living Adjustment, COLA. Black Small Square Return of Premium. 3.3.4.1 Cost of Living Adjustment, COLA. Long-term care services are, by their very nature, required on a long-term, often permanent, basis. Benefits provided by long-term care insurance are limited to a maximum daily rate. Over time, inflation could easily push the daily rate for long-term home care or nursing home care well beyond the maximum allowed for under a long-term care policy. For the above reason, most policies offer an inflation protection rider, at an additional premium cost, that will automatically increase the maximum benefit available, typically in the range of 2% to 3% per year, to help the benefit to keep pace with rising costs. A more detailed analysis of COLA can be found in Chapter 2 of this manual. 3.3.4.2 Return of Premium, ROP. Many long-term care policies offer a return of premium benefit at time of death of the insured if the policy has been claims-free. The amount returned, refunded, will vary from contract to contract, but is usually a function of the number of years the policy has been in force and claims-free, as much as 50% of premiums paid for a 10-year period or 100% for 20 years. The cost of the rider can add anywhere from 25% to 50% to the basic policy fee. Example: Antonia paid $1,800 a year for her LTC insurance policy, including a $400 annual extra premium for a return of premium rider providing for a 25% refund of total premiums paid over an 8-year claim-free period. She died this year after having paid into the policy and been claims-free for 10 years. Upon her death, her estate received a $4,500, 25% times $1,800 times 10, return of premium benefit from the insurance company. Benefits received by way of a return of premium rider, like all benefits paid out under a long-term care policy, are tax-free to the insured whether those benefits are paid directly to the caregiver/care facility involved in providing care or to the insured by way of reimbursement for services previously paid personally. 3.3.5 Policy Benefits. Long-term care benefits are payable on either a reimbursement, repaying the insured for expenditures already made, or an indemnity, paid directly to the care provider, basis, subject to daily and overall limits specified in the contract. While nursing home care benefits are generally paid directly to the facility providing the care, home care benefits are paid on a reimbursement basis, with the insured first being required to pay for the services provided himself and then provide the insurance company with receipts, in order to seek reimbursement for the funds expended on qualifying services. Example: Kashif, age 71, suffered a stroke 18 months ago that resulted in limited mobility. Consequently, he was restricted to his home most of the time and had to have nurses, a physiotherapist and a housekeeper attend him regularly. Kashif paid for these services himself and then claimed a reimbursement from the home care clause under his LTC insurance policy. Unfortunately, Kashif suffered a second stroke 3 months ago and is now confined to a nursing care home full-time. Costs not covered by the provincial health care plan are now paid directly to the nursing home under the indemnity benefit provided by Kashif's policy. Reimbursement is determined as a maximum amount per day or per service/equipment, and the insured is only reimbursed for the amount actually spent on care. The maximum is not simply paid out regardless of the actual expenses incurred. Daily maximums for home care can be acquired in increments of anywhere from $10 to $350 a day, and the maximum overall benefit is calculated as a number of days of coverage at the maximum daily rate. Qualification for benefits is subject to medical evidence of needs certified by the attending physician, using the ability to perform the ADLs as a guideline. Benefits will commence upon the date of certification and upon the provision of the qualifying services. 3.3.5.1 Tax treatment of long-term care benefits. All benefits paid out under a long-term care policy are tax-free to the insured, whether those benefits are paid directly to the caregiver/care facility involved in providing care or to the insured by way of reimbursement for services previously paid personally. 3.3.6 Premiums. Premiums for LTC insurance are generally payable for the life of the contract, subject to a waiver of premium provision if and while the policyholder is on claim. However, some insurers offer a fixed-term option for premiums, 20 years for example. This could permit the insured to pay up the policy prior to retirement. Long-term care policies are generally guaranteed renewable, meaning that the policy must be renewed annually for the life of its term. Most policies, however, contain a provision that premiums may be increased at the discretion of the insurance company, provided the increase is applied to a given class of policies, not merely to the policy of one policyholder. Each premium payable is subject to a grace period, such that the policy will remain in force for 30 calendar days after the due date of a monthly or annual premium, should the premium not have been paid on time. The policy will usually lapse, become void, should the premium do not be paid during the grace period. The amount of premium payable depends on a number of factors. Black small square amount of coverage provided, daily and overall maximums. Black small square number of days for which benefits are payable. Black small square type of coverage provided. Black small square elimination period under the contract. Black small square underwriting characteristics of insured. Black small square requirements to qualify for benefits. 3.3.6.1 Tax treatment of long-term care premiums. Premiums paid for LTC insurance are not a deductible expense for income tax purposes. They may, however, qualify as eligible expenses for purposes of claiming the federal medical expense tax credit. 3.4 Coordinating long-term care, LTC, insurance with other types of accident and sickness insurance. LTC insurance has both similarities and differences with the type of coverage provided by disability income replacement and critical illness (CI) insurance contracts. Many of those factors are outlined in Table 3.2. Table 3.2 Characteristics of disability insurance, critical illness insurance and long-term care insurance. 3.4.1 Long-term care, LTC, insurance and disability insurance. There is really no risk of overlap or duplication in benefits between the two types of coverage because disability insurance replaces lost income and does not provide cash specifically to cover the expenses of the disabled insured. However, long-term care coverage covers medical and related expenses but provides nothing in the way of income replacement for the afflicted. However, some insurers permit conversion of a disability insurance policy to long-term care coverage, up to a prescribed age of the insured. 3.4.2 Long-term care, LTC, insurance and critical illness, CI, insurance. There may or may not be a risk of overlap or duplication in benefits between the two types of coverage, but the potential overlap is difficult to avoid. CI insurance provides cash to allow the insured to adapt to costs and life changes arising from a specific cause, like a stroke or heart attack. The consequences of the event may not place the insured in a condition that would require the types of service/support provided by a long-term care policy. Nevertheless, cash would be provided by the critical illness plan. On the other hand, the event that triggers critical illness benefits, a stroke, for example, could easily result in cognitive or other impairment that would also result in impairment qualifying for benefits under a long-term care policy. There is no way of knowing in advance which type of consequence might arise from a critical illness, and, since critical illness proceeds are not specifically tied to any use, there would seem to be no practical way to build in offsets between the two types of coverage. 3.5 Limitations of critical illness, CI, insurance, and long-term care, LTC, insurance. The existence of insurance coverage is not a guarantee that all medical and care needs of an afflicted individual will be accommodated. Even with the most comprehensive coverage, gaps may exist between the insured's needs and the conditions covered, as well as the benefits available. Particular attention needs to be paid to contract wording, definitions, and differing medical opinions. The importance of contract wording. As with all forms of insurance, the wording in the contract is crucial. The start date for benefits will be set out in the contract, for example, and only benefits that meet that determination will be payable. Never assume that a client should be covered. The contract wording needs to be examined closely and applied to his situation. The importance of definitions. Definitions of covered conditions are critical in determining whether an individual qualifies for benefits. The insured may feel that his condition qualifies him for benefits, and his medical advisors and a care facility may agree. However, benefits may not be payable unless his condition meets the precise definition found in the contract. For example, contracts will set out the degree of cognitive impairment that will qualify an insured to claim benefits, and any level of impairment that fails to meet the conditions of that definition will not warrant benefits. Furthermore, statistics from Munich RE25 indicate that by far, the most common reason to decline claims under their policies was that the insured's condition did not meet the definition of the condition as specified in the contract, 42% of declines. It is important to note that definitions evolve over time, and different contracts issued by the same insurer at different times may vary in their definition of a given condition, depending on when the contract was issued. With the advancement of medical technology, it has now become much easier than in the past to diagnose severity and damage. Again, some claims that would be paid out under the old definitions would no longer qualify with the new definitions and the new technology. Different medical opinions from the insurance companies and the policyholders' medical advisors. Unless he resorts to courts, the insured is at the mercy of the insurance company's medical advisors when it comes to determining whether he qualifies for benefits. Even if the insured has written opinions from one or more qualified medical practitioners asserting that his condition qualifies for benefits, the insurance company's experts may not agree. Chapter 4: Insurance to Protect Savings. Competency Component. Black small square. Analyze the available products that meet the client's needs. Competency Subcomponents. Black small square. Analyze the types of contracts that meet the client's needs. Black small square. Analyze the riders that meet the client's needs. Accident and Sickness Insurance. Chapter 4: Insurance to Protect Savings. 81.